Harry Dent is one of the most controversial guests on YouTube. His bestsellers, going back nearly 3 decades, have shaped the thoughts of investors, economists, and traders. His deflationist outlook, including forecasts of sub-$1,000 gold and sub-$10 silver, has left audiences speechless. With a wacky 2018 so far, including 2 corrections and a US dollar mega rally, we get Harry's thoughts on current events and future outlook. Go immediately to portfoliowealthglobal.com/bear and download our 11 unique strategies for controlling your portfolio in this precious metals environment, which many deem a bear market.
Welcome to the Industry Experts panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today, we are thrilled to be welcoming back to the show Mr. Harry Dent. Harry is a legendary financial expert and the founder of Dent Research. He has appeared on Good Morning America, PBS, CNBC, and Fox. He has also been featured in Barron's, Fortune, and the Wall Street Journal, just to name a few. The reason that he is so sought after is that his advice and insight as to how to take advantage of his financial predictions is extraordinary. His books are bestsellers. They include, for example, The Great Depression Ahead and The Demographic Cliff, in which Harry shows why we are facing what could be a great deflation and how to position for this very rare event. His newest book, 0 Hour, warns of a huge political polarization and why we might see a major revolution that is set to rival the creation of democracy itself. And Harry's latest bestseller is called The Sale of a Lifetime, in which he shows all of the opportunities which will abound once the upcoming reset has begun. Harry, welcome back to the show. How are you today?
Nice to be back, Michelle.
Oh, you are a very busy man. Now, we want to start off with a question to you. Harry, do you still stand by your triple-digit gold price forecast and your single-digit silver price prediction? If so, what would cause such a scenario to play out, and when, from your perspective, might this occur?
You know, one thing, Michelle, it's something I've just changed recently in my newsletter and a conference I just put on for our subscribers. And in that, gold, I have this bubble model, which we came out with first in The Sale of a Lifetime and then more so in 0 Hour. And it's worked really good. Stock bubbles, commodity bubbles, real estate bubbles around the world. There's 2 indexes it's not working as well on, and that's gold and Bitcoin. So gold went up, had a bubble like everything else, started to crash like everything else right on our model, crashes in half the time it took to build. But it did not crash back to what I call its bubble origin, which would have been about $450 on gold. And $700 was another key long-term point of support on any kind of like long-term chart. Well, it's been basing out now for 3 years. It should have been there by now. It should have been somewhere between 450 and 700 by now, and it's not. And the same thing, Bitcoin should have been back at 1,000 after hitting 20,000. Instead, it's based out for many, many months. This is a much shorter time frame. The same way, it's the 2 things that have not followed, and I think it's because people still have, a feeling like, hey, gold is special. It is somehow, money is in question and finance is in question, and there's some redeeming value that gold may show yet. And of course, Bitcoin and cryptocurrencies are the new digital gold, they call it. So those 2 things are holding up well. And I actually think it's a good chance. Now, I don't think like the gold bugs. Okay, gold may have maybe seen its worst here at 1,050 back in late 2015. Been going sideways for 3 years. I think it will probably retest 1,050, maybe 1,000. But I think it could hold there and then be in a long-term bull market again. But I'm going to emphasize long-term, not like the gold bugs. They think the world's going to collapse, the dollar's going to go to 0, and then gold's going to go to 5,000, 10,000. That is not going to happen. U.S. dollar is going to be the safe haven. Cryptocurrencies have a better shot at attempting to be that because gold is just limited in supply. But I do think gold may have seen its worst, and we, of course, see another 30-year commodity cycle. Gold has peaked, if people didn't notice, every 30 years on that commodity cycle. So it is still primarily a commodity. It's just a special one. It's got, it's the most concentrated, highest value along with platinum. But it still trades like a commodity long term. It peaked in 1980, and then it peaked again here in 2011. Most commodities peaked in 2008, but right in that 30-year cycle. And so I see another peak. I think gold could see that legendary $4,000 or $5,000 number, but it'll be when I'm dead. It'll be about 2038, 2040. But I think people, we have a lot of subscribers who still like gold. They know what I've been saying. They know I've been saying it's going to go down, and it has. We've been right about that. The gold bugs have been wrong, but I think they're happy to hear that, because a lot of people still holding it, and that, hey, this thing may just be bottoming out here, and you may be able to hold it long term. And again, I think it's going to be one of the biggest commodity rallies in history when third world countries, emerging countries, are driving the economy more than developed, because they spend a lot more of their money on commodities. And of course, they're also big commodity exporters and metal exporters. So, and of course, our analysis always shows in a commodity boom, guess what does best? The metals, not the agriculture, not the cattle and meats and all that sort of stuff, and corn and soy. Those things are expandable. Metals, you have to dig deeper to get it. So I always like the metals when you get a commodity rally. So I think gold's like maybe okay here, but I don't see it appreciating near term. It'll probably go more sideways for another year or two, and then we could see a long-term bull market. So we'll see. I'll keep our people updated on you, but that's one of the few forecasts we've changed.
Wow. Now, Harry, talk to me about silver.
What's that?
Talk to me about silver.
Okay, silver is like little me gold, mini me gold.
Right.
It's lower price. It's not as concentrated value. It trades a little less like a monetary metal, but somewhat like. But it's also about twice as volatile as gold. So I mean, if somebody wants to buy metals for the long term, and I think silver might settle down $12, $13. I used to think 6 to 10, but if gold settles at 1,000, give or take, they could settle 12 to 13. Well, silver should go up nearly twice as much as gold long term. So silver is a good bet to combine with gold for metals, and silver and gold are both easy to buy. I love a lot of other metals like tin and nickel and lead. These are things hard to get, but it's not easy to invest in them. You can buy gold and silver ETFs and coins.
Right. Now, Harry, shifting gears just a little bit, the millennials have now eclipsed the baby boomers in terms of size of their population. And they've entered the workforce in recent years, especially since President Trump's election. They're just beginning to buy homes and cars and take vacations, which translates into the fact that the demographic cliff has largely been avoided up until now. So, in your opinion, are the baby boomers' withdrawals and liquidations, does that still pose a large and immediate threat?
Well, first of all, we're very misunderstood on this. The millennials have been entering the workforce for over a decade now.
For a long time.
But,
I know.
But the old generation continues to age, spend less, and retire. It takes the new generation getting well into their cycle to start to offset the old. The way we project generational trends is we simply lag the birth index, which we adjust for immigration, which is now becoming a bigger deal. They just found out we have twice as many illegal immigrants as they thought, and maybe more than that. So we move that forward for the peak in spending, 46 for the baby boomers, probably going to be 47, maybe 48 for the millennials. They're not at that point where we can measure that. The leading edge of the millennial generation, the very early ones born in the late 70s, have not even reached their peak spending yet for us to measure that. But we can tell they're having kids 1 to 2 years later, so that tells me it's going to be 47 to 48. So that's the way you measure it. The bottom of the cycle in between the baby boomers and the millennials, which means the Gen Xers, the declining generation, that doesn't bottom. That bottoms between 2020 and 23, and that's always been the case in our forecast. So we're not over the baby boom decline yet. We will be maybe about 4 or 5 years from now, and then that generation will drive us up. Now here's another big difference, Michelle. There's the size of the generation, but there's the magnitude of the wave. The baby boom generation, if you look at the Bob Hope generation that came before them and the millennial after, the baby boom's like 3 times the magnitude of the increase in births in the size of the generation as the Bob Hope, and the millennials are only about half the magnitude. They had births over a longer period, and they started from higher levels. So yes, if you count all the millennials, there's more of them, but the impact of a new generation coming up, driving up trends, will not be as strong as the baby boomers were from 1983 to 2007 on that 46-year life. So that's a difference too. The millennials also are coming in a different era. Credit is tighter now on homes. Homes don't look like this. Oh my God, you can't lose buying a home. Well, people have lost buying homes.
Yeah, you can, right?
Of course, the last generation that did was the one that came before the Bob Hope generation, the Henry Ford, that bought them in the roaring 20s and got zonked, and much more zonked in stocks. So this generation is not spending as aggressively, especially on homes. A lot of them are saying, should I ever buy a car when I can just Uber? We'll see new trends there, but so far the millennials have not been buying homes to the same degree at the same age as baby boomers. They may down the road, but I'm telling millennials, look, you should still wait. I know if you're 30 something, you're going to want to buy a starter home here. Wait until this present bubble. This second bubble looks just like the first one in real estate. Same magnitude, just started a little higher and going a little higher. This bubble is going to burst over the next several years. Wait until that burst, and then you're going to get a much better deal on a home and probably an even lower mortgage rates, because they're going up now. We predicted that as well. Only for maybe the next year will mortgage rates go up. Then the deleveraging of the economy will bring mortgage rates down, and it'll bring stocks especially, but also real estate down substantially. So I always tell millennials, you're the big winner. Baby boomers are the big losers if we have this big financial bubble burst in commodities, which have already largely happened, real estate and stock, because they own them all. Old people own most of the financial assets, and of course the top 1 to 10% own almost all of them of those. The millennials are going to benefit because housing is going to be more affordable all of a sudden a few years from now, because we're going to have this reset, and they're going to be able to get a much better deal on housing and then free up much more money to spend on other things. And they love to travel and do experiences. So
now, prediction-wise, when do you predict that would be best to buy a home? When is this second bubble going to burst and then sort of flatten out?
Well, I tell people that housing last time around, stocks took 17 months to hit bottom. Housing peaked a year, almost 2 years a year and a half in advance of the stock market. In price, they peaked 2 years in sales, but in price. So they peaked before, and then they didn't bottom until mid-2012, whereas stocks bottomed in early 2009. So housing takes longer to come down. So I think you got to wait until at least 2023 to start looking at houses, although the worst of it will come when stocks crash the worst, just like in 2008, early 2009. And I think at that point, that'd be more like 2021, 22. You may be able to find great foreclosure deals or something. So it just depends. But I'd say housing, wait a little longer. Stocks, I think you're going to be able to buy into the next boom by mid to late 2022. So that's still 3-4 years from now.
But it's not that long, really.
No, it's not that long in, long-term investing land. And again, if you buy stocks now, you're an idiot. We do think there may be one more leg up next year, but that's it. Our cycles say we're either peaking here recently, and we should know that, by the way, that one of the things I warn people about, especially aging baby boomers, when a stock bubble, as opposed to a bull market peaks, like in the late 60s, early 70s, that was a long-term bull market. A bubble like 1929 peaks, or 1989 in Japan, or 2000 in the tech stocks, or now. When a bubble peaks, the first crash is usually 40 to 45% in the first 2 to 3 months, and you just get whacked. So bubbles keep drawing people in, and they keep going up, and it's like, oh, you can't lose, and you're an idiot if you're not in it. But then when it goes very fast. So I'm tracking this recent top and saying, through past bubble tops, and saying, okay, if this was the top, and the same thing I did in January of 2018, I was saying that could have been a top. Look, very bubble-like, all perfect, but I didn't see that big crash. It only went down 12% in the first 2 to 3 months. I said, that's not it. That's not it. So here we are. We were down about 10 or 12% recently. We're bouncing. If this is the big top, then we should see another even stronger crash, probably start in the next week or two at most. And we ought to know probably by early December or end of this year whether this is serious or whether we've just seen another correction. And then we're going to see one more leg up into 2019. Our strongest cycle that's left, I call it the bubble buster cycle. the 90-year cycle, hits in mid to late 2019. That's the most likely time for a top in the stock market by my estimates. And but we'll see. This could have been, but like I say, I think I'm going to know in the next month and a half whether that was it or not. And I still favor that we're going to have one more leg up, and that's the time period when Bitcoin, after basing out at 6,000, could go run to 25,000 in less than a year. That's what it did. It went from 1 to 2,000 to 20,000 in like 6 or 7 months. So,
Right.
so Bitcoin is likely to be the biggest play here if it can hold its base, and if we do have one more bubble in the stock market.
Awesome. Now, Harry, Ray Dalio, the world's #1 hedge fund manager, believes that the largest threat to the progress of the United States is the need to fund the deficit spending with currency printing in order to offset the rising interest payment costs. He believes that the next recession would crack society's problems wide open. Therefore, he predicts inflation. You have been a famous predictor of deflation. Have you changed your views?
You know, I just read his recent book about debt crisis. It came out in digital, and now it's just coming out in print. It's a good book. People should read. He really did a thorough analysis. What he looked in there as what causes a hyperinflation cycle, those are more rare. And it's never been a worldwide phenomenon that we have the whole world in hyperinflation. It was just Germany after World War I. And it was because they had lost the war, were already bankrupt, and then the Allies put these huge reparations on them. And he described the hyperinflation cycle perfectly. It comes when a country has high foreign debt, and they're having to drain their country of money to pay off those debts. And when they do that, their currency goes down, and that makes those debts more expensive to pay, and you get in a spiral. It's when you're subject to foreign debts. United States is not that. China's not that. Turkey is. Venezuela is. And those are the countries, and Argentina, those are the countries having an inflation problem out of it. I do not see hyperinflation. I see modest inflation now because the government is funding a deficit now in boom times of $1.2 trillion. That is crazy. Trump is going to go down as making a huge mistake, giving a big tax break to corporations when they have the highest profits compared to GDP in all of history, in the top 1 to 10% or richest they've been in all of history. To give that tax break was stimulative to the economy. It's going to look really stupid because we got 1.2 trillion now to fund because some of the deficits are off balance sheet, and he points that out as well. The Fed is also draining now, selling off their bonds. That's another 600 billion in the next year. 1.8 trillion. That is going to cause interest rates to squeeze because who's going to buy that many treasury bonds? China, Russia, and some other countries are already selling them off to defend their own currencies against a rising dollar. We predicted the rising dollar not falling. We've been predicting falling inflation. Now we say inflation spike over the next year, and then we go into deflation. When debts deleverage, when financial asset bubbles like these, real estate, commodity stock, when they deleverage, it's a big reset. Stocks in the U.S., the Dow went down 89% in 2.5 years and never got back to those levels for 24 years. That money disappeared. That's wealth. That's money in people's brokerage accounts. Whoops. Oh, it's not there anymore. And it's not going to come back to a new high as in a bull market or a bubble market. Debts, not government debts. The U.S. government can't afford to default on its debt. It's going to have big problems. I think we're going to see a $2.5 trillion deficit in a downturn. But they can't default on it because we're the reserve currency, and it would damage our credit rating too much. Venezuela can default. Iceland defaulted on their debts because they're a little country and they can do it and blah, blah, you know. And they do get, Iceland got inflation when they defaulted back in 2000, whenever, 9 or 10 or 11 or something. So this takes money out of the system. Less money chasing the same consumer goods and the same financial assets means lower prices on everything. I see deflation, not inflation. I see inflation only near term, and we've been predicting that, but it's a short-term spike, and we've been telling our subscribers, hey, you know what you want to do to play it safe in a downturn when everything's going to fall? You buy the highest quality 30-year treasury bonds, 20-year AAA corporate bonds, because they benefit from deflation. When interest rates go down, inflation goes down, it turns to deflation, their rates go down. You could lock in today a 30-year treasury for 3.4%. I think within a year you may get 4.3 for that. You lock in that rate higher than corporate dividend, but those bonds will appreciate when interest rates go down, the economy goes down. Stocks, commodities, real estate, everything else, and junk bonds and higher risk bonds, corporate bonds, will go down. Only the highest quality corporate bonds, AAA, and the treasury bonds, and the best bonds, maybe Germany, maybe not, frankly, because I think Germany's in much bigger trouble than people think it is demographically and supporting the euro, and the euro's also supporting it. So I wouldn't even buy German bonds, but I'd buy U.S. treasuries and corporate AAAs on this interest rate spike, hold them while everything goes down. Then you use the profits from that and the liquidity from that to turn around and buy stocks and commodities and gold and stuff longer term.
Wow. Now, Harry, do you believe that Bitcoin is a technology of value?
Blockchain, that's a different definition,
right,
is a technology of value. I think it is Internet 2.0. I agree with the experts in that industry on that, but it's in its early phase. We just had on our conference a speaker, Lou Bazinais, who said there's always this, when a new technology emerges on the heels of successful old technologies, like automobiles first emerging when railroads were peaking and stuff, and and now, I mean, Bitcoin coming at the very end of this technology, second technology bubble. You get a hype phase. People say, oh, God, the old internet was so great. The internet's the greatest thing in the world ever. Well, people don't realize the first internet bubble was almost as crazy as the Bitcoin bubble. Companies put .com on their name, had no sales in some cases, certainly no profits, except for a few big ones like AOL, and then they went up to 400 times profits. That's crazy PE ratio. They get hyped up, and then they crash. But something that magnitude says, no, this is the next big thing, so you buy into that crash. You don't buy now. Well, Bitcoin did go up to 20 and crash to 6. I think it's going to go to 20. I think there's a good chance, at least a 50-50 chance, it's going to have one more run, new high, maybe 25,000. And then when it crashes back to 6,000, maybe a little lower, then I would buy it, because long term, on a lag to the internet, there should be a boom in blockchain companies and technologies into about 2036, 2037. And that times well in the next global boom we see now. But here's the difference. What's wrong with Bitcoin? These coins were used as a way, kind of like crowdfunding, a way to raise money for new companies without having to go through the incredible regulations of an IPO. So it's an ICO. Oh, we're not selling a security. We're selling a coin you can use to buy stuff from us. Okay, that's BS. I hate to say it. But you know what? It's not a bad thing. I think it's a good thing, because it allowed this industry to get off the ground. The scale of what this thing has done so far is not as big as the internet at the same stage, but it's getting there. This is a something. And I think it's Internet 2.0. Internet made communication ubiquitous globally and real time and fast and cheap. This is going to make things of value, transferring money, investing in things of value. And the internet is horrible at that, buying things of value. I mean, people getting hacked all the time. I got hacked 3 times in 6 weeks, and I finally got a super serious password. And I'm ready to give up the internet. I'm like, it doesn't work anymore. It's just too hard to keep changing passwords and stuff. It isn't secure. And for transferring money like to Mexico for an immigrant here, 20% it costs, and it takes a week or two. Bitcoin could do that for 0.2% in a day. So it is the future. It makes the internet better. It's not as radical an innovation, even though the people in the industry think it is. But it is a big innovation, and I see it as a long-term technology. But it's a blockchain. It's a way of managing things of value and getting things done on the internet rather than just email and Google and search and communication. And the internet sorely needs that.
Now, Harry, do you personally invest in blue chip stocks?
No, I don't. I don't really. I've invested mostly in new ventures, companies like me, and unfortunately, I've been more successful than the companies I've invested in. But it was just, my nature. I mean, I was trained at Harvard Business School to be a corporate consultant. My first 2 years' work was in a Fortune 100 company and in the central finance department. So I always thought, oh, okay, I'm going to be a corporate manager. No, I'm anything but a corporate manager. I'm more like a disruptor, out-of-the-box thinker. And so I just graduated. I ended up consulting to and running entrepreneurial companies. And then, of course, I started my own and stuff. So So I'm just not drawn to like buy an S&P 500 contract or to invest in Fortune 100 companies. I'd rather put my money in companies I think could change the world. And that they are disruptors. And you know, people think, you know, small business. No, most small businesses are not disruptors. They're dry cleaners. They're, you know, local businesses. They run their own business, so they're more accountable than somebody working for a company and relying on them for a paycheck and healthcare and retirement, all this sort of stuff. Disruptors create something that didn't exist before. There was no predictability in most of economics before I came along, and I wasn't an economist. Is why I came up with it. Economists would have never come up with this. And I started taking economics, and I threw it away after 3 quarters. I said, this is useless. This industry is not where it should be. I knew from science, my study of science, and working in some business consulting, that there are things predictable about the economy, and people are incredibly predictable. Ask a life insurance actuary. When are you going to die? 78.86. They give it down to the decimal point, but for the average person, that's the key to prediction. Don't try to predict Joe or Susie. Predict the average household in the United States, piece of cake, decades in advance. And so I focus on that sort of stuff. I made a lot of things. I mean, demographics wasn't even a factor largely in economics. Well, I didn't intend to do that. I was just working with entrepreneurial clients, dealing with baby boom clients who were young back then, starting new trends, and young people do start new trends, and that's where you look. You don't look for old people in most cases. And I started seeing how big the baby boom was and started measuring them. And then next thing I know, oh my gosh, we know when they spend the most money. Why should it be a problem to predict when a new generation is going to have the biggest impact on the economy? Move forward the birth index, 46 years, piece of cake. So that's what disruptors do. And I didn't think I was a disruptor, but I am, you know, and I had to kind of keep stumbling onto stuff to find that out. And I was seen in my Harvard Business School class as a disruptor. When the teacher conducts a conversation there among a lot of bright people, and he's got to know who to call in for, you know, the manufacturing insight or the accounting, the reality, or the marketing, of the, you know, whatever. When he wanted a left field, to open the whole case up, he would call on me. I was the out of the box thinker. I was the disruptor. I didn't even see it then, frankly, but
but you do now.
Yeah.
Now, Harry, what are your views on President Trump's confrontations with the Federal Reserve?
Well, yeah. No, you're not supposed to do that. I mean, he appointed a more conservative Federal Reserve chairman, number one. So it's already leaning towards him more than others would have. But you don't tell the Federal Reserve what to do. The Federal Reserve is supposed to counter the economy. Now, first of all, I think the Federal Reserve is a crock, okay? It's not an accident. They were created in 1913 to 14 to smooth out we had some rough business cycles in the late 1800s. They call it the Long Depression. There were like 3 or 4 depressions in a row. And so people are like, hey, man, we got to tame this crazy economy. So, okay, we're going to have the Federal Reserve, and they can come even things out. So when things go down, they lower interest rates and they stimulate the economy. Well, what ended up happening is they stimulated and kept the economy healthy so long it got unhealthy. If you don't have recessions to let businesses kind of readjust and clean out and get rid of bad debts and bad companies and inefficiencies, you just get more and more inefficient. You get more sick. So they created the greatest bubble in history in 1929. And then guess what? We had the greatest depression. We've had major long-term downturns and depressions before, not like that one. Federal Reserve comes on the stage 2 decades later, greatest depression, stock crash and crisis in history. They created that. It would have happened anyway. They probably made it twice as worse. I always tell people, I tell doctors this. I think doctors don't understand the human body with all they know. They see colds as the enemy. Colds keep you healthy, you idiots. Colds clean out stuff. When you get too stressed or too toxic or eat bad or drink too much, whatever you do, or get out in freezing weather without a jacket because you're an idiot, you're going to get sick, and your body needs to clean out those wastes and excesses. Keeps you healthy. Better to have a lot of little colds than one big pneumonia. That's what happened with the Federal Reserve, and that's what's happening now. We didn't correct the big debt crisis of 2008 to 9. It started to, but when they saw banks failing and major institutions and General Motors and AIG, they just said, "Oh, we got to bail out everything, and we got to print trillions of dollars to keep Humpty Dumpty from falling off the wall." which means we never got to fix the fundamentals. So we're going to come back to it. This time it's going to blow. And now that we've taken more of the financial drug, just think of it like crack, okay? If you keep taking crack, every time you get high and start coming down and you take more crack to feel better, how does that work out? That's what we've been doing, essentially. And I'm not oversimplifying. That's exactly what we've been doing. So you can abuse debt. Debt is a performance-enhancing drug. You get today, you get extra performance, extra money, extra economic growth today at the expense of what? Tomorrow. You got to pay that debt back with interest. And perhaps in a time when the economy's not so good. So that's why we need to go through this reset. We need to have this deleverage. I'm not going to be happy till I see some major financial firm. I mean, Goldman Sachs could have gone on it. Even Goldman Sachs in 2008-9, they saved their asses. I wish they hadn't. I'm not going to be happy till I see some major financial institutions and companies go under, zombie banks, zombie companies, and we see deflation in prices for a period of time. That's telling me, okay, we're cleaning out the system. We're getting healthy. It's time to grow again. That's what we need to see, and we didn't get that. We started to get it. 2008 was like 1930, but we didn't get the 31 and 32 to really clear it out, and so we're going to be back at square one, only worse, because we have more debt than ever. Bubbles are bigger than ever. And if I hear one more dumbass economist or financial analyst say, oh, this is not a bubble, because I got my pictures of bubbles. You want to look at my pictures of this bubble versus the tech bubble and any bubble in it and say this is not a bubble, be my guest, because I'll make you look like an ass, because this is the greatest bubble in history, and China makes us look like nothing, especially in real estate.
Now, staying with that topic, the broad market crash, when it happens, how severe do you think it will be percentage-wise?
Well, again, history's real clear on this. Well, you know, the 40s, 50s, and 60s boom was not a bubble boom. It's just a normal, nice, long bull market, generation spending money, you know, debts going down from the government, from the Great Depression, all, you know, everything was going in the right direction. Productivity, highest ever. With that generation. Well, when that ended, what we had was a long 50% crash in stocks. And we had this 70 recession, then some stimulus, then the 73, 74 recession took us deeper, and then 80, 82 was the deepest. That was the end and the bottom of the Bob Hope down cycle. 50%. Now, if you adjust for inflation, the Dow 70, maybe S&P 60, but still, wasn't anything like 1929 to 32. 1929 to 32 saw 89% stock crash in a little over 2.5 years. That's a bubble burst. But when stock bubbles burst, real bubbles, like the tech wreck. What was the tech wreck? 78% crash. The Japan Nikkei went down 80% before it was over. That's what you get when a bubble bursts, because they're more exaggerated. So you should be expecting 70 to 90% in stocks, 40 to 50% in real estate. And remember, real estate for people's got debt against it most and leverage with mortgages. So it's a lot worse than it sounds. And then people get thrown out of their house and ruin their credit. You don't ruin your credit for losing money in stocks, okay? But you do when you get thrown out of your house or can't make your payments. So not to expect, same thing with commodities, 70, 80, 90%. You know, gold went down, you know, more like 70% in the early 80s before it turned around long term and got into this next bubble. So bubbles are bigger. And this bubble is more comparable in my book to the 1929 to 32 crash we have ahead. It may be cushioned somewhat by government stepping in, but I think governments are going to lose credibility this time around, and they've kind of blown their wad. So I don't think people, when you print it, I mean, if you add it all up, $16 trillion was created out of thin air globally, all central banks in concert, to prop up an economy that was dying. Well, that just means, you know, we're more out of whack now. So I think I think stocks are going to go down. My forecast is about 80%. I think that'll take about 2.5 years. It'll be from maybe late 2019 into mid to late 2022. And what I said earlier is the most important. Half of that, 40% or more, will happen in the first 2 to 3 months, and people will just get slapped right out of the gate and be, you know, walking around like, what happened? Because they would listen to their stockbroker and everybody or these traders saying, well, that's all right. Just stay in. Stay with the boom. Stay with the bubble. And then when it corrects, you can start to get out. No, not when it goes down that fast. People will panic on that 40% down, and then it'll bounce, and they'll wish they'd stayed in, and then it'll go down 80% or more. So this is not something you sit through. Even the 70s downturn, it was long and it was kind of cascading. It did. You could have kind of sat through that and rebalanced and done semi-okay. You don't sit through the 29 to 32 crash, and you don't sit through what's coming, from my view. And history proves that. 24, 25 years to get back from bubble bursts like this. Back to even.
Wow.
You'll be dead by then, and you still won't be even.
Now, from your perspective, have we entered a bonds bear market?
No.
Okay.
And all of Wall Street thinks that, which makes me more convinced. We are near the bottom of a bond bull market. I mean, the top, because yields have been going down since 1981. Near 40-year. We had a 40-year bear market in bonds from 1941, and from 81 we've had a near 40-year bull market in bonds. This is the last wave. We got the 10-year Treasury got to 1.38%. That's the lowest it's ever gotten in U.S. history. Everybody thought that's it. Now we're going, 3.22 today. And then I'm projecting maybe 4% on the 10-year and 4.3% on the 30-year Treasury. People can think it's over. Everybody's saying that. No, I think we haven't deleveraged yet. We haven't gone through deflation, which we did in the 30s. So I think there's one more big downturn in bond yields. And when that 30-year gets below the 2.1% it was at recently, the low, and the 10-year below the 1.38% it got, we get down to maybe 1.5% or something in the 30-year and maybe 1% in the 10-year, then I say, okay, now you load the boat. That's when you get out of bonds, actually, not load the boat. You need to be loading the boat now, because bond yields, loading the boat when they go up a little higher. But once those yields come down, you get out of bonds. Bonds are going to be in a bear market for many decades. Not 40 years this time, but maybe 2025. Probably into about 2040, give or take. That's a long time. So you don't want to be in bonds. You want to be in stocks. And if you want, bond-like dividends, buy utilities and buy high dividend stocks. But bonds are not going to be the place to be when inflation is bottom long-term and it's going to go up. It's not going to go up as much as it did before. But I think that bond bear market is coming. It's not here yet. We got one more bull run, and it's going to be a doozy. If that 4.3, if we get up to 4.3% on the 30-year, give or take, and we go down to below 2%, those bonds are going to go up 30, 40% in value, and you're going to get a nice dividend all the way down while you're holding.
Wow. Now, Harry, touching really fast on something I mentioned at the top of the show, your latest bestseller, The Sale of a Lifetime.
Actually, the latest one is 0 Hour, Sale of a Lifetime.
0 Hour, okay.
Yeah.
Speaking with that, when the reset happened, could you, for everybody who hasn't read your book yet, when it does happen, what are some of the best opportunities that you see to snag?
Well, that's an important question this time around, because the last time we had a great reset was in the 30s, especially 32 for stocks and 33 for real estate and commodities. If you'd have bought anything back then, anything standing, you'd have made money for decades and decades and decades and decades, even to today. This is different. The developed world is peaking demographically. We've peaked, and it's going to take substantially longer lifespans, which I think decades ahead. I think our kids and grandkids will see this. I don't think I will quite, but longer lifespans will change this demographic picture. But for now, developed world, except for a few exceptions like Australia, where I'm speaking this month, where they've had such strong Asian immigration, high quality immigration, by the way, that they have demographic trends that continue to point up for decades. We don't. We go sideways at best in the U.S. A lot of Europe and East Asia, Japan, et cetera, just go down forever. So it's going to be the emerging world. And since China has so greatly overbuilt and overinvested, which I've been harping on for years now, and you wait and watch China. China's going to go down like an elephant, because they have the highest debt of any emerging country in the world. They have grown the fastest, leveraged the most, and they got excess capacity and everything. Normally that would already be in a bust economy, but the government just keeps it going. When that thing busts, real estate's going to go down 80% there instead of 40 or 50 here. And stocks are going to go down 80 or 90% or something like that. So China is going to take a long time to recover. India is going to be the next China, and Southeast Asia. Asia, I have another long-term cycle, very clear. China dominated the world in 1820, and then Europe came along, West Europe dominated into recently, along with the United States now, North America. And starting in the 80s, we're moving back towards Asia again. The coming decades are going to continue to favor Asia. So the emerging countries in Asia, again, India, Southeast Asia are my picks for investing in the stock market and in business, and real estate, things like that. And in the commodity, the next commodity boom, like I said earlier, metals. You know, buy gold, silver, platinum, lead, zinc. Buy BHP and Vale and companies like that that are big global mining companies. Those will tend to do very well. So I think it's going to be more selective. Emerging countries going to do better than developed. Asia is going to do better than the rest of the emerging world. And the metals are going to do the best in the commodity world. And a lot of other things and a lot of other countries may struggle even in the next global boom. Japan's going nowhere forever. And the United States really goes more sideways. I mean, it'll be a good investment to buy it at lows in the markets, but I don't think real estate will ever appreciate like it did before in developed countries, because there's more people dying to offset the young buyers. And that's a new phenomenon as well. So a lot of things are going to change. So you're going to have to be more selective in the next global boom. Everything's not going to go up like if you'd have bought an 82 at the bottom of the last major downturn or 32 to 33 before that. You could have bought anything and done well at those times. Anywhere in the world almost. In any sector, commodities, real estate, stock. That's not going to be the case the next boom. There's going to be great opportunities, but you have to be in the right places.
Harry, it is always amazing to have you on this show. Please tell us about Dent Research. Please also talk about your websites, how everyone can follow your work, and please really hit on your free newsletter.
Yeah. Dentresearch.com is our main site. You can see all the kind of things we do. We have a series of newsletters. We have, all types of special reports and research. We've got a new book called Spending Ways, which we've just updated this for the first time in 10 years, where we show 200 categories of consumer spending. It's anything related to consumer spending and business, we can tell you when things in your industry peak rather than just when spending peaks overall at age 46. The best way to get to know is just get on our free newsletter. You just go to harrydent.com. And you just put in your email address and you're on. And half the time they'll send you a free book while you're doing that. Sometimes they do, sometimes they don't. But harrydent.com is the best place to go started. Get on our free newsletter. We're putting out a lot of good information right now because we're at such a critical point. So that's what I recommend. And then get 0 Hour. I tell you, I recommend another book just for somebody else who really looks at the facts and history. It's called Factfulness. That's a book as a parent or grandparent I'd be giving to my high school and above kids and grandkids, because between 0 Hour and that book, they will know more about the world and what's really happening than taking a whole economics course at the best university. I'm just telling you, because we got the facts. Everybody else has the theories. Our books and this guy, Hans Rosling, has the facts. And they did a questionnaire to 30 top political, financial, and world leaders around the world, and they all flunked a 20-question test on the state of the world and simple questions that facts would be clear on. So if you want to be smart, read up a little bit. And you don't have to read everything. That 0 Hour and Factfulness, boy, you'll be way ahead of the pack just reading those two books.
Excellent. Harry, thank you so much for coming on the show today.
Okay. Thank you, Michelle.
Mr. Harry Dent, financial expert, best-selling author, commentator, and the founder of Dent Research. For the Industry Experts panel, I'm Michelle Holliday at PortfolioWealthGlobal.com.
Silver Bull, the famous Chris Duane, who mints his own coins, discusses triple-digit silver prices. Vortex breaking down how the end of the crypto bear market will catapult Bitcoin to new fresh all-time highs. Jim Rogers outlines exactly how the crash will happen. And Charles Nenner on major stock market crashes and gold crashes. Portfolio Wealth Global continues to pound the table that this bull market is not over in stocks. In fact, Starbucks, our latest stock profile, jumped from $51 to over $63 in no time as it opens a new China branch every 15 hours. Make sure to subscribe to the newsletter as we reveal our picks for 2019.